10% of the software market are private companies that have raised it over $1 billion valuation, right?
Amazing.
How many of those companies actually will go public? Nobody knows, right? But lately the answer is close to zero. It rounds to zero.
Hello, data nerds. My guest today is Michael Walrath. Michael is the chairman and CEO of Yext, a publicly traded digital presence platform. Prior to Yext, Michael co-founded Right Media, which was the first at-scale digital ad exchange, which was acquired by Yahoo in 2007. He's also done a whole bunch of other amazing things in the tech world and even in golf too. Michael, welcome to World of DaaS.
Thanks, Auren. It's great to be here.
Really excited. Now, the number of software vendors has been increasing dramatically, over the last couple decades.
Yeah.
Are we going to see more software vendors continue, or are we going to see more vendor consolidation?
Wow, we go right into predictions. Yeah. So when we started Yext, we counted, we've kind of gone back and looked at this. There was something like 200 vertical software vendors selling to, front office. We call it kind of the CMO or the CMO, CIO combo. Today we count about 14,000.
Wow. 200 to 14,000.
Yeah. And I'm talking 2009 to...
Yeah, that sounds about right.
To today.
Yeah.
And we can unpack, we could probably spend the whole time talking about why that's happened, but I think there are myriad impacts to that. Some of which are
I would love to get your. I mean, it's easier to sell to software. Back in the day, maybe you'd have to sell something that was like a $3 million implementation to make it make sense. Now you can start with a $3,000 thing, right?
Yeah, totally. Yeah, I think that was the whole software is going to eat everything, and I think it did, right? And I think. Easier to input, easier to use, less capital cost up front, all those things.
And that also means before the average one of these companies may have had 6 tech vendors and now they have 60 type of thing.
I think 60. I wish I had 60.
Yeah.
Right. The first one of the first things I did when I got here as CEO, I've been here for 15 years, so it's ultimately my problem no matter what. But when I took the CEO job, I asked the team to give me an audit. I had a whole list of requests. One of them was give me an audit of how many software vendors we're using. And the number was 120, right? And
that sounds pretty normal. Yeah.
Yeah, until you start to get into the details and you realize okay, we're using this one for CRM, we're using this one for sales planning, we're using this one for prospecting, we're using this one for marketing, and you start to go, okay, we seem to have 7 or 8 of these that are all just being used by the sales team.
And you got a LinkedIn subscription and these ads over here and all this other stuff.
It's you're using Salesforce, you're using Clary, you're using and that's just on the selling side, right? And the marketing side, there's a whole nother piece of it.
Yeah. Yeah,
so that's how
the payroll vendor and just all this stuff, right?
Yeah, and when you realize, and then if you really start digging into it, you start realizing is that you need more than one, right? But for any given thing, but you don't need 7. And and part of the reason, look, I think this is all well intentioned, right? A lot of companies got funded, money was free. There were a lot of needs, and it became, being verticalized was the hot thing, right? There's a period from 2010 to 2015 where if you weren't verticalized, you couldn't get funded because it was no, you have to, the sort of conventional wisdom of the early stage investment community was you have to be incredibly verticalized so that you can own a little vertical. And that's how, now, what we're seeing today is that those businesses are really struggling in this environment because finally money isn't free. And the other big part of this that has to be talked about is that, this was the 12 years of the digital transformation, right? So you had, highly elastic and nearly unlimited budgets classified under, large enterprises undergoing the digital transformation. COVID accelerated that, right? Yep. And so we saw what happened with the combination of ZERP and COVID and the digital transformation. And so I think what people in a lot of cases are struggling with is understanding why is everything that worked for 12 years not working anymore? And a big part of it is that it's way too fragmented. And as the CMO for the first time in, probably 2 years ago, the CMO for the first time in 12 or 14 years, was hearing from the CFO, hey, I'm not giving you unlimited increase. You don't get a 20% increase or a 15% increase or a 30% increase this year. You got to hold your budget flat. And you have to potentially reduce some headcount. And all of a sudden it's like, well, how am I going to manage 100 software vendors with less money and less people? And so this is where what I think we're seeing as a macro shift is if I'm a CMO, a CIO, a CFO, I'm starting to think about, I have fewer people doing more work. Fragmentation is happening everywhere, and I need to consolidate what's happening. So, the very long answer to your question, which really just required are we going more fragmentation or are we going consolidation? I think we're going consolidation.
Just and obviously not going back to 2009 time frame where we're not going from 14,000 back to 200, but we might be going 14,000 to 10,000, or how do you think of it?
Yeah, I mean, the question is how many of those 14,000 are actually still alive, right? So when you couple the fact that we've had this massive proliferation of, you listen to enough podcasts, these numbers start to float around in your head, right? So I forget who, maybe it was on the All In guys were talking about this a couple weeks ago. 1,400 software unicorns, right? Private software unicorns that raised at over $1 billion valuation, right? So 10% of the, we're using that number of the software market are private companies that have raised at over $1 billion valuation, right?
Amazing.
How many of those companies actually will go public, right? And that was the discussion that I think they were having. And nobody knows, right? But lately the answer is close to zero. It rounds to zero, right? But I think the bigger question is how many of those companies actually still have a business, right? Or still operating, have a growing business or even a business that's not sort of, declining. And the capital markets are pretty close to most of those businesses. So, that tells me that it's probably not, 14,000 to 10,000. It might be 14,000 to 7,000. It might be 14,000 to 5,000 over time. Partly because broader platforms make the world much better for the marketer in a lot of ways, but particularly in an AI world.
There's also this weird thing where to sell, if you're doing enterprise sales, it's super expensive. You have to hire these expensive salespeople, and it just takes a really long time. You have to do a lot of sales and marketing. So you have to raise all this money to go do that. And then, of course, if it's really expensive to sell to them, you have to charge a lot because the selling costs are so high. And so you have to charge a lot more than it is. And so you have all these companies kind of got in that zone. Every once in a while, we buy a lot of software sometimes from it's one guy or one gal company. Or maybe 3-person company, and you just kind of go log on their site. Somehow you find it, you log on their site, and you just pay in credit card. It's super cheap. And they're doing incredibly well. They've got a multi-million-dollar business. They're doing incredibly well for themselves. They've never raised money. And there's so many on that side. And it seems like the number of vendors there just keeps going up. And maybe none of those businesses are ever going to be, $100 million, $200 million businesses, but a lot of them can scale to 20 million and do incredibly well for the owners.
And I agree. I think that's a part of it, right? And I actually think that's a lot healthier because those tend to be product-led growth companies. They tend to be the companies you find through referral. They have CAC ratios and things like that make sense because they're not supporting a big enterprise sales team and things like that. So the ones that I am more focused on, because we do tend to sell into larger enterprise, are the ones that who've kind of drank the Kool-Aid around growth at all costs is the only thing that matters. You can spend unlimited sales and marketing dollars and unlimited R&D dollars as long as you're getting the growth, because at the end of the day, that's what market valued for a very long time. I mean, it's an unprecedented thing that we had 12 years where the only real mechanism for valuing software companies, even scaling software companies, was growth, right? And so I don't know how many of those 14,000 are those healthy kind of PLG type companies. I think it's probably a significant number, and I think they're a lot less exposed because, like you said, they're profitable. They make money. They're not trying.
Or even if they're not PLG, maybe they've got some service side or something like that, or whatever. They're good businesses.
Yeah, we work with a lot of those companies on the reseller side of our business, and they do an amazing job servicing the SMBs and bundling and packaging things together. And in a lot of cases, they have some home built software, and then they are OEMing our software in. It's a great deal for us, and I think it's a good deal for them too, because it would be a massive investment for them to build what we've built, but it would also be a massive investment for us to sell to those tens and hundreds of thousands of smaller businesses. So those type of economic structures, I think, work really well.
Now, every year there's someone who's predicting like massive consolidation.
Yeah.
You see these kind of crazy logo slides, let's say in Martech or ad tech kind of world. And every year someone's saying, we're going to have so much consolidation. And then the next year, the slides get even crazier and crazier. But at some point, like you reach a point, it can't get more crazy like it does, so that's what you're saying. It's like, okay, I'm calling peak oil now. Like I'm finally calling the craziness right now.
Yeah. Well, I think I figured out that like making bold predictions like that is just a bad idea. Right. Which hasn't really necessarily stopped me. I think, I've been a little more bearish probably than most of my peers overall. And I think some of that bearishness is just seeing the unsustainability of some of these financial models inside software companies. And so, I'm not necessarily predicting that there's going to be a massive wave of consolidation. I just think there's going to be pressure across the board. Yeah. And companies who understand that breadth wins in an environment where the budget is constrained in any way, right? Breadth wins because you can bundle and package smaller competitors out of the market, and that I think is a trend that we will continue to see as long as there's pressure on the budgets of the enterprise, which I don't personally think is going to abate anytime soon.
And what is going to, like you mentioned all these companies, there's so many companies out there that have raised, let's say $100 million or even more than that. Yeah. They're doing well. And a lot of them now have found a way to get to profitability. Yeah. But they're definitely not worth what they raised it at. They may have raised 100 and now they're worth 150 or 200 tops. And they can't really sell the company because then with the pref stack, the founders won't really make as much money. So they just kind of like keep going. Keep compounding, and if they keep compounding enough, then maybe with the pref stack, it works. Is that just what's going to happen? They're just going to keep like building the business slowly.
Yeah, I mean, I think we're seeing different approaches, right? So I actually, if I were advising, that kind of private 100 million ARR company, what I would advise them is get profitable, right, and control your own destiny. The market will not. Your investors are very unlikely, especially if your growth is slowing, which it's all slowing, right?
Yeah,
I mean, I think
everyone's slowing.
Yeah, a year and a half ago, there were we look at our public peer set, and there are like 40 or 50 companies who we kind of track there, and a year and a half ago, 2 years ago, probably more than half of them were growing at over 30%. Now, wow. I don't think there's a single company in that group that's growing at over 30%. I was talking to an investor of ours, a really smart investor of ours who's been investing in software for a really long time. And he said something I thought was really interesting. He said, look, 20 years ago, a company that sustained growth at 30% for any period of time was a unicorn.
If you're enjoying this podcast, please sign up for our newsletter. Go to worldofdas.com. The link is in the description below. Now back to the video.
It was a total outlier. And what we've seen over the last 10 years is that if you're not, that it was like the minimum bar, right? If you're not 30% growth or higher.
Yeah, this rule of 40 idea. Yeah.
Well, and look, I think rule of 40 has a lot of merit.
Because it could be 20 EBIT and 20 growth or something.
Sure. Or 10 growth and 30.
10 growth. Yeah. That's a good company.
Yeah, that's a great company. And historically, that was a company that, that the market really valued because you compound 10% growth and 30% EBITDA over 10 years, and you create a ton of value, right?
Yeah.
We went through a period for 10 years where just that whole notion of there are different ways to create value went out the window. It was only one of those metrics mattered, and it was the growthy one. So anyway,
and if you're growing at 40%, but you're negative 25% EBIT or negative 30% EBIT or something like that, which, and sometimes they're negative like 100% EBIT, then it's less good.
Well, and look, we all understand why that happened, right? When money was totally free, and your next round was, we saw this for a shorter period of time in the late '90s, where the next, it was all just how fast can you get to the next round,
Yep.
right? I think we saw that in this world for a much longer period of time, but those companies who you were talking about, those 50 million ARR, 100 million ARR companies, they've all seen their growth slowing too.
Yes.
It's harder to sell.
Some of them have negative growth. They're still good businesses, though. They have a good product. People like it, and maybe they're going from 100 this year to 99 next year or something. But they're profitable and they're fine. They're just never going to hit the valuation metrics that they once raised at.
Yeah, or they'll have to, or they have to they have to find a way to restart the growth engine in a meaningful way. So this, I think then this comes down to we have a tendency to take very short lenses, right? And so if you can get profitable, then you, as a software company, you basically have forever to figure out how to get a growth engine going again, right? Now, your investors don't want it to take forever, and if you're public, they certainly don't want it to take forever, which is part of the thing that I think we've struggled with.
Yep.
In terms of, not in terms of what I think is fundamental value creation, but in terms of perception. So my advice to those companies has always been, and we've invested in a bunch of them, get profitable in this type of an environment, and then you have all sorts of options. I think what, in a lot of cases, founders and CEOs and teams are learning the hard way is that you could logically see your way to a down round. And, I think it's really hard for folks who haven't been through one of these cycles to understand that the down round is actually probably the worst thing for your investors. It's actually probably worse than an exit at less than the preference stack, because, I think a lot of investors would rather, and maybe this is a controversial point of view, but they would rather take 50% of their money back now than have to mark their investment down 50% and have that hit their unrealized returns. And so part of the what we've seen talking to founders is they assume that, well, I raised my last round at a $500 million valuation, I can always raise money at 200 or 300 million to bridge, and they can't, right? Because the investors would rather sell the company for $100 million for capital raised than let you raise at 250 or 300.
Yeah, exactly. It's also it's like there's certain personality types of CEOs.
Yeah.
And if you're not growing that much, and let's say you're burning $500K a month, even if you have $20 million in the bank, that's going to take a long time. I got 3 years of runway or something.
Yeah.
But if you're not growing, there's certain types of CEOs is like, great, like I'm making the cuts now, and then once I figure out the growth engine, I'll reinvest.
Yeah.
And there's other ones like, oh, well, I've got these 20 side projects. I know it's going to happen. I know the growth is going to happen. I'm going to keep it going, and I'm not going to make the tougher decisions. Like, is there something like you could know, like by meeting with CEOs, that they would be one type of personality or another? Like, could we give them a personality quiz or something? Or
yeah, maybe. I mean, that's probably, if investors were actively investing right now, that's probably the sort of thing they'd want to do. But it's interesting. These you don't see a lot of fundings happening, and I think
that's right. Yeah, these are people who raised money a long time ago. They just may have a lot in the bank.
Yeah, I think one of the things, and I think about this a lot because because I'm old now, right? So I've been around for a long time, and this will be the third downturn cycle that I've, my first one was I started working.
We're like same age, same kind of vintage. Yeah.
Like we are lucky because basically I entered the workforce 1999. I had a sales job at DoubleClick. I was 24 years old, and that stock went up $20 every day. And I got a couple thousand options, and I was like, this is perfect. I'm going to be a millionaire, right? Stock's at $200. It's going to go to $500, and I'm going to be a millionaire just off this. And that all ended very, very quickly. And I think in my first 2 years there were 9 rounds of layoffs. There were it was an unbelievable experience. But and I'm sure we were both living through the same world at that point. What it created in me was a sense of like, okay, this is what happens in downturns. And then I started Right Media in late 2002. There was basically like one VC in New York. It was Fred Wilson, and he invested in consumer. So there was nobody to talk to. I found Jonah and Noah Goodhart, who were my customer at DoubleClick, and they funded the company. They wrote the first check into the company, but all that did was give us 6 month runway. So we had to figure out how to make money, and we had to figure out how to, reinvest the cash flow into growth. And if you think about it, in tech especially, that was the last time, 2003, 2004 was the last time that like the market required an efficient growth model. Because by 2005, we were ripping. 2008 was a speed bump for tech. And then we caught the digital transformation wave. And it's been just an enormous party since, until we hit the end of 2021. And this and I think the party is officially over, and the hangover is bad. But the crazy thing is, inside the company, we've got people, who've been in the workforce for 20 years who had never been through a layoff. They never experienced it before. And so I think that's why this is such a difficult time for a lot of people, because the party was so long.
Yeah, that's really interesting. What else has changed about running tech companies over the last couple decades?
Everything and nothing. I think the longer lens we can take, the more value we're going to create, right? And so, I've kind of belabored the point that I think we got really myopic about a single metric over the last 15 years. And
growth. Everything was just so focused on growth.
Growth. Yeah. I mean, there was a point, I'm going to pick on ourselves, right? There was a point, and I was the chairman of the company, so it's on me, right? But I think it was in 2020, maybe it was 2019, we were spending 74% of our revenue on sales and marketing.
Wow.
And we were declining growth.
Yeah.
And the answer, the default answer inside the company was, well, the only way we're going to get more growth is to spend more money on sales and marketing.
Yeah.
Right. And in a lot of ways, we all bought into it, and like, I should have known better, right?
Yeah.
Like we all should have known. We all should have known better.
I've made that. The problem is I've made that exact mistake like 5 times in my life. Or so, it's like you would think you would learn after the second time or something.
Well, and look, we were public. The market was only paying for growth. It was better to be highly unprofitable and growing 25 or 30% than it was to be highly profitable and growing 10 or 15%. But there were so many like myriad just terrible consequences of making those types of decisions. For example, we had twice as many salespeople as there was availability of market opportunity there. So what happens in that scenario is
they're hurting each other.
They're killing each other. There's not nearly enough to go around. And your best salespeople go, and by the way, this is in 2020 and 2021, when Google and Datadog and MongoDB and everyone who's thriving, they might as well have been they're all within basically. Yeah,
they're going to go somewhere else because they're not getting the leads that they need.
Yeah, and so if you have a time machine, right, you go back in time and you disregard the fact that the market is only paying for growth, and you say, look, over 10 years, the right answer here is, instead of having 200 salespeople, I should have 50. Those 50 should be the best. They should make amazing compensation, and then there will be enough demand to go around. That might mean we only grow at 10%, but actually will be, you're much more likely to be a rule of 40 company growing 10% and having 30% margins in that scenario than you are. And that was just a little bit of a unique quirk.
By the way, I have found across the board of almost every company that we've been kind of double clicking into, that almost every company has like 2x, 3x, 4x more salespeople than they should have. Like if you look at the salespeople's calendars, like the best salespeople are just not busy enough. I'd rather pay the best salespeople twice as much, but have 25% of the salespeople, make them super happy, their close rates are going to go up. Like they're going to be, you give your best leads to your best people.
Totally.
Then this kind of like more spread the peanut butter thing.
Yeah. And it's spreadsheet math, right? So it's really easy to make it work on paper, right? If I have if I have 200 salespeople and they're booking $400,000 a year each, which is a terrible sales
That'd be
productivity.
terrible. Yeah.
Terrible,
oh my gosh.
Terrible.
If you had a
But
salesperson book $400K a year, this is like very hard to make money.
well, yeah, I mean, you're paying them that much money, right? So
Right,
forget like overall like cost of acquisition. So just I'm making those numbers up, but if you're in that scenario, it's really easy to build a spreadsheet which says, well, hey, like if growth is the only thing that matters, if I had 400 salespeople doing $400,000 a year in sales, then I would at least be doing double the bookings, and my overall ARR and revenue growth would be higher. And you can actually convince yourself that will work. But what it does is so doubling the sales team there, what you see is, the most likely scenario is that they're going to do 200K each in bookings, right? But actually it's worse than that because the best ones leave, and you wind up with 400 doing 150.
Or no,
and you're now,
even if the best ones don't leave, your close rate starts to go down pretty dramatically because they're not getting the good leads. So if your close rate was 10% before, now your close rate is going to be 5% overall. It just becomes so it is a little bit of a death spiral.
Yeah, and so I mean, I think you asked the question like, what's changed? I think what has to continue to change. The market is applying gravity to a for the first time in starting in a couple of years ago. For the last 2 years, we've been feeling gravity for the first time in 12 plus years. And so as management teams, I think we have to shift from a zero gravity environment to a gravity environment, which I'm not an astronaut, but like I've heard that makes you sick. Right. That makes you feel, and that's what we have. We have a lot of people who are feeling sick about the fact that like all the rules have changed and all the things that work so well for, a decade just or longer just don't work as well anymore. People, I don't, not everybody loves this, but I love this environment. I think this is the environment where
you're more of a wartime CEO.
I just would rather be in an environment where great execution is differentiated.
Yes.
Right. And I think, and if you can, and look, this is hard. I struggle with this every day. If I can put myself in a mindset where I think in terms of 5 or 10 or 15 or 20 years, then, what happens this quarter, what happens next quarter is so much less important than exceptional execution over time and judging the environment correctly. And so that is why I like this environment, is I think it forces you to think really carefully about what's available and what's not available.
One of the things that was happening before is you had these like, let's say 100 million ARR companies, and they had like 1,000 people.
Yep.
So it's like a 100K ARR per person or something.
Yeah.
And then they would eventually go to 200 million ARR, and they would have even more than like 2,000 people. Like they didn't get any more efficient over time.
Yeah.
And you have this, like, one of the problems with adding more people is just the management goes up dramatically. You have this coordination problem internally that becomes really, really hard to deal with. And it's one of the nice things about being more lean is it's just easier. You don't have to be like the world's best manager anymore to manage a company as it grows.
Yeah, I mean, I think, we talked about the sales productivity and those expenses and things like that, but there's also there was this, we just went through this weird period where like it became really important how many people were in your organization, right? We would interview people, and by the way, we were losing, there was a period where I think we were having like 40+% annual attrition because people were going to the Datadogs and the Googles.
Yeah, of course.
We have, you
have to have this huge recruiting engine all the time. And then people, they have to spend all their time interviewing people too.
Totally.
That's a huge time waster if you have to spend like half your day interviewing people.
Yeah. There was a year where we hired like 600 people and grew the company by 50 heads, right? It was like, it wasn't 600 people out of 10,000. It was like, we had 1,300 people. We hired 600, and the company grew from 13 to 1,350.
Yeah, right. A lot of people leave.
Yeah, that was just the war for talent, right?
Yeah.
And what was it to me? What was interesting about that time is so we were interviewing constantly, right? And I've had to kind of rebuild the management team in a lot of ways here. And you so over and over in interviews, what you'd hear people talk about is, well, I managed an organization of 500 people, right? It became a thing that the LinkedIn profile says this company has 1,200 people or 1,500 people or
Yeah.
whatever it is, and we got so enamored with all types of growth, right? How big is my organization? How many people do I manage? How many VPs work for me?
Yeah.
And all of that is this like incredible weight for an organization to carry. It's a compensation problem. It's a silo problem. It's a communication problem. It's all those things. We are very much moving back towards how efficient can we be and how much of our effort converts into thrust. And I think it completely changes that conversation from size is good.
I remember being kind of in this vortex just a few years ago in 2020 and just really starting to scale up. And the whole time I'm back in my head, I'm like, I know this is a bad idea. Like, I know I can't absorb all these new people right away. Like, I know we probably don't need all these people in marketing or something. Like, but like, I don't know. Somehow I did it anyway. Like, I don't know why I did all these stupid things. Like, it seemed like somehow we just had this collective like stupidity that hit all these founders and CEOs at one time.
Well, look, it was everywhere, right? It was, and I think at the bottom, I'm not an economist, but underneath it all is the economy of growth, right? So, money didn't cost anything. We had to go get growth, right? Venture investors, private equity investors, everyone had to deliver returns and had to deliver growth. And it just works so unbelievably well for so long. As long as I'm growing, I can sell it to the next guy. And the next person can build their pro forma that says this thing will grow like this forever. And then there will be someone else who will pay for that growth. And so we got in this moment where it was like, we took as like just religious truth that, that 10 times ARR was what a company was worth. Right. With no other, question of like, well, how much does it burn? How much does it make? Like,
exactly.
Things, right. I don't know if there aren't very many trading for 10 times ARR, but it used to be like, it was just certainly in private rounds. It was just like, hey, that was the starting point.
Yeah. Exactly. And it kept going up. Like I remember when we sold LiveRamp 2014, we got a little bit less than 10x ARR, but we're profitable and we were growing like almost 100%. And then and then it's like, if we just probably waited 2 years, we would have got like 20x ARR. So,
for sure. Yeah. No, I mean, that's when we sold Right Media in 2007, I think we sold for 13 times revenue and like, 9 times ARR. And like, I remember people, getting phone calls like, I cannot believe that. Like it's a crazy number.
Totally.
Right. And I felt like it was a crazy number.
Yeah.
Right? I was like, how does anyone justify paying me 10 times,
exactly,
ARR? And like you said, 5 years later, it was like, the number would be 2 or 3 or 4 times that.
Though today, I mean, we have one of our companies I've been involved with, like they're a good company. They're they're growing at 50% per year. They're a little bit more than 50 million ARR. They just did a raise at roughly 500 million, so that they were able to command still that 10x. And not yet profitable, but good company. So it still is happening, like even like right now.
Totally. Yeah. No. And look, 50% growth on 50 million of ARR. That's impressive.
Yeah, it's pretty awesome.
Like that's a company that is succeeding, and if you're not burning. If you're not burning a ton of money to get that tells, as an investor, and I've done a lot of this, I would look at that company and I would say, okay, that is a company that has product market fit, that, has some level of efficiency. And, if you're 50 million, you're growing at 50% and you're burning $5 million a year or even $10 million a year, you're sort of in that rule of 40,
totally.
Category. And that feels, now, if it's burning $50 million a year to get that 50% growth,
that's a problem.
It's a completely different scenario. So, what I think has changed is that it didn't matter, 2, 3, 4, 5 years ago. If you were burning 50 million to get that 50% growth, you still get that 10 times. There was indiscriminate kind of funding. And I think that's where the pain is in the market today is, you can't afford to burn $50 million a year to grow 50% at 50 million of ARR anymore.
Yes,
And
makes no sense.
people aren't going to fund that business.
Now you were chairman of Yext,
Yeah.
and then you became CEO, and so now you're in some ways like, how do you think about running your board meetings differently now that you're CEO, where you kind of like started on the board there than you would like if you just kind of like started as CEO?
Yeah, I mean, it's certainly been an evolution, right? So when I was building Right Media and we raised our first round of institutional capital 2 years after we founded in 2005, all of a sudden I had to have a board meeting, right? The board meeting before that was me and Jonah and Noah having a conversation whenever we felt like we wanted to, right?
Yep.
It was a private company that was owned by us, and so I was at that time, I was 28 years old or something like that. And, I had to learn how to run a board meeting. I didn't have a clue, right? Like the Red Point guys were very patient. They were like, hey, here's some decks, right? Because I showed up to the first one, I had no deck. Like I'll just talk and write on the whiteboard, right?
Yeah.
And they're like, this is gonna, we're going to need to do this a little bit differently.
Exactly.
So, having gone through that and then, having gone to Yahoo and been part of a much, much larger organization and stayed there for a couple of years through a really turbulent time. I learned a lot about how those board meetings were run and things, and sort of how to operate at scale, which, and then 12 years of sort of the Yext board and other boards. What I think has changed most is that I think a lot more in the boardroom, the way I thought about the company before I had investors. Right. And what I think is missing in a lot of cases in the boardroom is that ownership mindset. That
strategic, like product oriented, like that type of thing.
Yeah. Like one of the things that I try to do in any boardroom is inject this notion of like, what if I know we're not, right? We're a public company. We have a responsibility to our shareholders. We do have shareholders in the room, of various sizes. What if this was a family business? How would we think about it if it was a family business?
Yep.
Right. And in that,
meaning like we have a very long-term horizon, that type of thing.
And a responsibility to think about, the value of every dollar we spend and to think about the balances between growth and profitability. And so Yext has gone from being, 5 years ago, one of those 30% growers that was highly inefficient to a company that this year, I think our consensus estimates have us in the, minus 1% growth as we've gone through a lot of changes and shifts in our strategy. So that's a huge difference. Yeah. But, that company 5 years ago that the market valued according to its growth profile was burning cash. This, our company, will approach, next 12 months, according to, again, I'm going to talk in terms of consensus numbers, something like $100 million of EBITDA, which translates roughly to free cash flow. Yeah. So like when we look at that and you think about it, and I put the hat on and say, okay, if this were a family business, how much of that 100 million of free cash flow or EBITDA, or however you want to think about it, would we, invest in growth right now in this market? Because it's our money, right?
Yeah, exactly.
And I think that is kind of the lens that disappeared in this kind of single mode market. But to me, it's the most important thing to bring into the room because it turns the conversation into a capital allocation and long-term value conversation instead of a how do we get the market to react the way we want the market to react in the short term.
And I don't, in my entire life, being on boards, running boards, including my own boards, I don't think I've ever had like a great board meeting. Like I've never been a board member of a great board meeting. I've certainly don't run great board meetings. Like, what advice would you give to people like me who want to like level up, who want my board meetings to be like much better?
Yeah. It's funny. I don't know that I've been part of hundreds of board meetings, and I would sort of agree with you that like, I'm not sure I've ever walked out of, well, that's not true. I have walked out of board meetings thinking, wow, that was a great board meeting. Usually that's when I've just delivered a whole lot of good news. right?
Totally. I've been in
Yeah.
those board meetings too, and
Yeah,
it's
those
like,
are, yeah,
yeah, or being on the board, and the CEO's like, "Oh, have any advice?" And you're like, "No, you're doing amazing. Like, I
yeah,
can't do
yeah.
anything for you. Like, maybe we should pay you more, but that's about it." You know?
No, and I mean, I think there was a period of time where Right Media board meetings were like that. Moat, which Jonah and
Yeah.
Noah ran, but
What a great company. Yeah.
I had the best job in that company too, chairman, non-executive chairman. I mean, I tell you more than like Right Media and Moat, like we never had a bad board meeting because every board meeting was just we're outperforming the plan, everything's working, and also, in our
But that
case,
doesn't mean the board meeting is that helpful. Like, it's like
exactly,
all the
yeah,
execs are there. They're
yeah,
spending 3 hours. Like, how
yeah.
are they really? Is it really a good use of their time? Right.
Right. No,
Yeah.
it's spending 3 hours high fiving.
Yeah. I mean, maybe that's good. Like, I mean, high fiving, like, celebrating each other is not a
Yeah.
bad idea either. Yeah.
No, it's a good thing, but I think where the board meetings get really good is when we get some tension in the room,
Yes.
and where there's some, what I would call constructive tension, right, around where we're getting pushed on, are these assumptions that you're making, and are these strategic decisions, and ultimately, are these investments that we're making, are they smart investments, right, over the course of
Yeah.
the long haul,
Well, it's true of any meeting,
yeah,
not just a board meeting, but like any meeting,
yeah,
is only good if there's some, internal meeting, at least some tension. Just like
yeah,
any movie, you're not going to watch a movie with no tension. Like that would be a
yeah,
really boring movie.
yeah. No, that's right, and I think it comes back to, like, I think we're entering an era that, like, when we talk about, like, maybe this, I'll make a prediction which might be embarrassing because this is recorded. So I think in 3 or 4 years, like, we might look at this and say, okay, like, I suspect in 3 or 4 years we're going to actually be in a really good place. I think that we get into the AI is going to be a huge tailwind. I think it's going to be a massive software is going to be a massive beneficiary of all these things. But I do think in that when the party is back on again in some form or the other, the companies that are going to be doing the best are the ones who took this time to inject a completely different notion of value creation into their DNA,
Yeah.
and effectively said capital allocation matters. It has always mattered. If you look at the sort of the last couple hundred years of capitalism, the best performance over time were people who, it's Warren Buffett. They know how to allocate capital, right? They know how to think in terms of decades. And so,
Have you read The Outsiders?
yes,
I love that
fantastic,
book. Yeah,
amazing
one of my
book.
favorite books.
Yeah,
Yeah.
but I think it's and the thing that's so amazing about it is that most of the people in that book I'd never heard of,
Yeah. Yeah.
right?
Totally.
Like they outperformed Warren Buffett,
Yeah.
right?
Totally.
Not many people have done that, right? He's a huge hero of mine, and I think what they do is amazing. But yeah, that's a book that tells the story of, and I think it's incredibly instructive in this environment where every dollar that we spend is precious and has to have a return.
Now, there's a lot been like written and talked about these kind of like smaller mid cap public companies, put Yext in kind of that bucket there.
Yeah. Yep.
And it seems, from the outside, it seems very, very hard to run these
Yeah.
companies as public companies. What is your advice to other CEOs going through it? And maybe your advice is to not do it. I don't know. But what's your advice to other CEOs going through all that stuff?
Yeah. I mean, I think I'm not sure that, well, in my lifetime, I'm not sure it's been harder to be a small cap public company. Partly because I just think the market doesn't care.
Yeah.
Right. So what's interesting is Yext was a mid cap public company when it was half its size and way less profitable. Right.
Yeah.
So
back in the day.
Yeah. You go back 5 years, we were literally less than half the size and burning tons of money, and we were worth 5 times what we're worth today.
Yeah. Crazy.
Right.
Yeah.
So there, today, if you again look at sort of the next 12 months consensus and then you do the enterprise value, like, Yext trades for something like, I don't know, it's 4 or 5 times EBITDA.
Yeah.
Right. Like, that's like an unheard of multiple, even for a low growth software company.
Totally.
It just is what it is. Right.
Yeah.
And I think, there are always different options that, teams and CEOs can pursue. What I try to do is not focus on any of that stuff and focus on, if this is a 10-year, 20-year, or 30-year time horizon, What's the things that I do today to create value in 10 years? That's not always an answer that my public shareholders love, because I think in a lot of cases their business models rely on returns much faster. And I think that's the fact that I've been very public and very vocal about that's the lens that I'm going to take. That may cost me some shareholders who are looking for a faster return.
And how does someone like you think about it? So you've got this business. The business itself is a very good business, super profitable, not really growing.
Yeah.
It generates all this cash.
Yeah.
So now you go back to your outsiders, like capital allocator hat. You have all this cash coming in, and your job now as a money manager to use that cash in an effective way. Like, how do you think about that?
Yeah. So we think this is something I talk about all the time internally, and with a board, and I talk to our investors about it also. Is there's really basically 3 or 4 things I can do with that cash. So one is I can just let it pile up on the balance sheet, right?
And that is really, it's like, well, maybe I'll come up with the idea later of what to do with it. Or maybe I need a lot more cash to go do something big, like acquiring something or do something big, and gives me some optionality.
Totally. Yeah. So I think,
certainly Berkshire Hathaway does that a lot. Like they have the amount of cash in their balance sheet, or Apple or whatever on their balance sheet is just astronomical.
Totally. So I think that's one option, and your enterprise value increases, on a 1-to-1 basis, right?
Correct.
The market generally will value cash at cash. So I think when you don't have anything better to do with it, that's a really good thing to do with it.
Sure.
I think there are at least 3 other
better
things
than spending it on random stuff. Yeah.
Well, it's certainly better than spending it on growth that doesn't materialize.
Correct.
Right. Because that is the worst thing you can do with it. So there is an element of, as a, capital allocation mindset, thinking about like, what does the 10-year DCF valuation of this business look like? If I can accelerate growth through organic investment and be less profitable, and I have really high confidence that I can accelerate growth, then I would be willing to be less profitable in the short term in order to do that. So that's just organic growth or organic investment of that cash into product initiatives, sales, marketing, R&D, things like that. The second thing is obviously M&A, right? And so I think in an environment where we have tens of thousands of vertical, or smaller software companies who can't raise money for the most part, and who are trying to and have these sort of existential challenges, there's going to be a robust opportunity for us to grow inorganically through acquisition. And if you do that in a really disciplined way, I think what happens is you can expand the breadth of your offering, and you can play into this kind of consolidation theme, right? So if we buy really smartly at really disciplined prices, and it strategically fits into the thing that our customer wants us to do more of, then it allows us to go in and bundle and package and be far more competitive. There are 10 other great benefits to that sort of thing, which is we unify the data layer, which sets the table for a generative AI, another types of AI wave, and all these other things. So I think strategic M&A makes a ton of sense, but it has to be very, very disciplined when you're dealing with sort of your own currency is
and you're gonna want to buy things that are at least quote, break even, and then maybe you have ability to grow that EBIT over time, unless you're really betting on the growth of that.
Well, and that's where I think you just get into a very high risk zone, right? Buying higher growth things that are highly unprofitable puts you into a mode of, it's kind of like saying, company. Hey, we're gonna, which by the way, Yext has a history of doing, and we all were on board with it, and those bets didn't pay off, right? Yep. And they came with downside that we have had to execute through. So, it's no different than saying, me spending $100 million on a company that's high growth and burning cash is really no different than me saying, hey, I'm going to invest $100 million of sales and marketing and R&D into a moonshot product offering that may or may not massively accelerate growth. Yep. It's the same. It's a capital allocator looks at it the same way, right? And then the third thing, which is a really useful thing, is we can return that money to shareholders in one of two ways. A dividend, which is a very unpopular thing for tech companies to do, although maybe we'll start
some
to
of
see
the big
more
ones like
Yeah.
Facebook and Microsoft and other ones have done this.
Yeah.
Yeah.
Yeah, and then but the more popular certainly and
Stock buyback.
stock buyback, and we've done a lot of this. I mean, we repurchased, I think, since I've taken over, close to 20 million shares, right, which represents 15 to 20% of the company's total share count. We
And how do you so I've seen a lot of companies are doing all these stock buybacks, but then they also are at the same time, issuing a lot of options.
Yeah.
And so it's kind of like, it's this weird, it never really works out. And what the company I was involved with, even LiveRamp, like they did a ton of stock buybacks, hundreds and hundreds of $1 million, but it just never really helped the stock price at all.
Yeah, no, I think so. First, I think this idea that like the stock buyback actually moves the stock price, it's, the rules are designed so that doesn't happen. We can only buy so much of the daily float, and like any public company can only buy so much. So you can't really move your stock price, right? I think
you move it in that, over time there's less shares, and potentially those shares are more, especially if the business is doing well, then they all have a greater claim to the future profits, essentially.
That's right. Yeah. Well, look, and again, it goes back to what's your lens, right? So the lens that I ask my team members to think about, and really anyone who owns, who works at Yext and owns shares, is is you're an owner, right? And so while it might be fun to take that money and like pour it into moonshots, right?
Yeah.
Or, the reality is if we take that money and we buy 10% of our stock back, everybody here now owns 10% more of the company.
Correct.
Roughly. I'm not a mathematician. There's probably, that math is probably wrong. It's probably 9%, it's 9% or something like that.
Yeah.
But
or 11%, depending on which way you go. Yeah.
Yeah. And so in order for that math to work, you have to be more than offsetting the dilution of new issuance, right?
Yeah.
Which then takes us back to this idea of like, do you operate efficiently or not?
Yeah.
Right. And the more efficiently
maybe
we
have less
operate,
people, and people are valuing different things.
Yeah. So this thing to me is like a tiramisu, right? It's like what's a 3-color cookie that my kids love so much. They're like the Italian cookies are like,
those are delicious. Yeah.
You got to layer these things on correctly in order for them to work, because buying a ton of stock back and then turning around and just issuing a ton more stock, like, it offsets some of that dilution, but like, is that really the best use of that?
And also, and back in the day, you're kind of like relating everything back to like 5 years ago. I don't think like the typical investor was thinking about this kind of like dilutive event from issuing all this stock.
Yeah.
They were calculating things like growth and EBIT and stuff like that, often without the stock comp. And now I think it's much more common to be using that as part of the calculation.
Yeah, exactly. These are like really complicated incentive structures, right? Where, it's almost comical, right? Like our financial, it boggles my mind how all this stock-based accounting works. But we're paying today. We're accounting for stock that was issued 4 years ago at $20 a share as expense at $20 a share, with the stock trading at just over $5 a share today.
Oh, really? Oh, God. Okay, so that's very complicated.
This is another one I could easily screw up, but like my understanding of it is that the expense that we recognize is based on the price at the time that we issued those shares.
Got it. Okay.
So there's this weird,
and then you've got like a 4-year kind of tail on it.
Yeah, you have like a 4-year tail, because most of those grants are like
even if the grants are underwater and no one's ever gonna.
Well, in our case, we use RSUs, so they're not underwater. They're just worth less than when we granted them, and so you have less incentive, but you're still carrying that cost.
Yeah.
So the types of things we just look at it again, and this won't surprise you based on our conversation. We look at issuance dilution, right? So we look at it and we say, well, how much dilution are we actually creating to ourselves and to our shareholders through all of these different mechanisms? And we should be looking. That's another thing you should, when you're generating cash and you have a lot of cash, you should be looking at is like, a lot of our employees look at these incentive structures as part of their compensation. And
course.
so they get a share of stock, they sell a share of stock. They're like, that's stock,
Yeah.
right? They don't
Yeah.
all look at it as a long-term investment. And so we have to look at it and figure out, should we be issuing, potentially giving them cash instead of stock because they don't
They
look
might
at
value it in a different way. Yeah.
Yeah.
Yeah, that makes a lot of sense. Oh, this has been amazing. We ask a couple personal questions.
Okay.
What is a conspiracy theory that you believe?
This conspiracy theory that I believe. I don't know if this qualifies as a conspiracy theory. And I'm going to say this, broadly. I believe this is completely outside the world of tech. I believe that our food and healthcare industries, in particular pharmaceutical industries, are not are making us sicker and not nourishing us. And outside of the world of tech, they're
doing it. They're doing it like because just the incentives align, or is there like somebody in the background actually being like, I want to make people sicker so I can make more money or something? So it's like the dentist trying to give you more sugar or something.
Yeah, I mean, look, I actually have a really hard time putting intention around these things. I think incentives create action, right? And so, and people, like to eat, stuff that's not good for them, right? It creates a chemical reaction.
I definitely
in their
do.
body.
I definitely like that. Yeah.
And so, I wouldn't necessarily call this a conspiracy theory from my standpoint. I think we just have to, this is the kind of thing. So I guess I'm dodging the question a little bit.
Was there anything you do on like the health stuff that, is a little bit out there or different or you think it's going to become more mainstream in the future, but not as mainstream today?
Yeah, well, I mean, so my wife, who is a great entrepreneur, has a. I'm going to plug her brand here. So this juice I'm drinking is, I don't know, you can see it, organic Crush. She has
okay.
She has 6 100% organic fast casual restaurants on Long Island, where we lived for most of the last 20 years. We're Florida residents now, but she believes, and I have come to believe over 25 years of her making me smarter, that so much of the chronic health problems and diseases and things like that we face as a country today can be solved through whole foods and whole nutrition.
Yeah.
And she's created this incredible brand of, delicious made to order and prepared foods that have no additives, no preservatives, no GMOs, 100% organic. And it's like, it heals people of various ailments. And so, like our life in a lot of ways is built around this idea of like kind of fundamental, wholesome, nutrition is actually the cure to a lot of, our problems.
Okay, interesting. Because like one of the things, I don't know if you've been like, if you're like a Peter Attia fan and stuff, but he's kind of changed his mind around diet. And he's kind of moved to where diet is, he thinks it's less important than he used to think. And he's been much more on things like exercise and sleep and other stuff over diet. But on you're kind of like saying, well, actually diet is fundamental. It's really important.
I think, but like I don't know if this is controversial, but what's different about it is that I think, we have gone, so we actually have with a great friend of mine, a film production company, we made a movie in 2014 called or 2010 maybe, called Fed Up, which was really a sort of a deep look at kind of the food industry and sugar in particular. And I think one of the things that if you over the last 50 or 60 years, most of what we've been told about like what actually is nourishing and wholesome is largely incorrect.
Yeah.
Right. We my philosophy
when I was a kid, it was like, instead of butter, let's eat margarine.
Yes,
totally. Everyone was eating margarine instead of butter.
Yeah. Yeah. And that all goes back to, I have wonkish knowledge of this, but in 1979, the McGovern report came out and we basically said, okay, like we're, milk and eggs and meat and, cheese are bad for us.
Yeah.
And over the course of 20 years, basically all of those things got replaced with processed food and sugar.
Yeah.
And now seed oils, which margarine was seed oils.
Yeah.
Right. And it turns out that actually all of those things, sugar, seed oils, processed food. They are what they create obesity, they create diabetes, they create heart disease. And there are these amazing stories now of
plus they don't taste as good. Butter's so tasty. Like it's just always tasted better than margarine. So it's like we went to, it was the worst of all worlds. You got like the worst tasting thing and worse for you.
Well, yeah. Well, the only way to make all that stuff taste good was to dump sugar in it, which we didn't even use sugar. We used, high fructose corn syrup. And so, I again go back to I don't know that there's intention behind this, but I think the evolution of our whole food system over the last 60 years is making us chronically ill. And to break out of that, it's like go back to your grandparents, right? What your grandparents ate a lot of red meat and I'm not telling anybody how they should eat. And I think all our bodies are different and everyone reacts differently to different things. What I found is that the more I eat kind of single ingredient whole foods, and particularly high in things like meat and eggs and things like that, I just feel better. I have more energy. I'm not always inflamed, and that matters at 50 years old, almost 50 years old. Like it makes a difference.
We're getting old.
I know. Ours is the generation that sort of we grew up with this. We're the test case, I think, for a lot of this stuff.
Totally.
Yeah.
All right, last question we ask all of our guests. What conventional wisdom or advice do you think is generally bad advice? And you already gave a lot of good ones.
Well, yeah, I could go. I could just say growth at all costs, but I think we covered that for about an hour.
Totally.
Good. This is a good question. You can edit
anything
out
in recruiting. You think is do you think there's conventional who you should recruit or how you should recruit or who you should work with or?
Yeah, no, that's a great one. I think the conventional wisdom around what it takes to get things done is something we need to seriously question. And it's thematically in line with what we've talked about, but how many people do we need to get things done? How many, we've lost the ability to think in terms of leanness.
Yeah.
I'd say we no longer default to any mechanism of what is the kind of the lean approach to this problem. And also, we're really good at addition and we're really bad at portfolio management. Right. Yeah. So we struggle with this inside the company all the time. Well, we need to do this, right? And the next question that needs to come out, the next sentence that needs to come out of everyone's mouth is, okay, if we need to do this, if this is the highest priority thing, what gets pushed off the plate?
Yeah.
And that goes so much further than just financial, right? That goes to distraction, that goes to thoughts, that goes to everything else. And so I just the conventional wisdom is there's always an opportunity to add more things to what we're going to do.
Yeah.
And what we should be doing is there's a time for that, right? There's a time for that when your whole portfolio is performing and you can get better performance by adding more. But this is mostly not that time. And so, you kind of, asked me for something different. And I probably gave you something the same, which I apologize for. But
no, that was great. That was amazing. Thank you, Michael Walrath, for joining us on World of DaaS. I follow you at Michael Walrath on LinkedIn. I definitely encourage our listeners to engage with you there. This has been a ton of fun. I really appreciate you coming on the World of DaaS. Thank you. It's been an awesome conversation. It's been great to reconnect with you. And if you're a super data nerd, go to worldofdaas.com. That's DAAS, worldofdaas.com, and sign up for our weekly Data as a Service news roundup newsletter. Thanks for listening. If you enjoyed the show, consider rating this podcast and leaving a review. For more World of DaaS, and DaaS is DAAS, you can subscribe on Spotify or Apple Podcasts or anywhere you get your podcasts. And also check out YouTube for videos. You can find me at Twitter at Auren, that's AUREN, Auren, and we'd love to hear from you.